But back here at home, investors have been nervously watching a key recession indicator, that being an inverted yield curve. Now, the yield on the 10-year note has been falling as a flight to safety has pushed bond prices up. Of course, other parts of the yield curve have already inverted, but it's the 10-year to the 2-year comp that has signaled every recession for the last 4 decades, and that's a warning sign we're now dangerously close to as we see the 10-year yield continue to fall, Brad.
So you want to see how closely we hit it? I mean, this chart needs to be updated to include the fact that we were within 1.5 basis points of an inversion earlier this morning. It's since widened just a little bit, but it's still really close. And everyone's wondering about whether or not that key 2 to 10 year split is going to basically go negative. It's, for what it's worth, been a very good indicator of recessions in the past. It's called all of the, I believe, 8 recessions since 1969. So a pretty good track record of preceding a recession. Now, the reason why people watch the 2 and the 10 year, you brought up the chart earlier of the 3-month and the 10 year, that had already inverted. But people say that the 2 and the 10 is the most, kind of telling indicator because they're the most liquid markets. The 3-month market is not as liquid as the 2-year and the 10-year. So if the 2-year does actually, end up being higher than the 10-year, people say, hey, people just do not have good viewpoints or expectations for the future.
But in addition to that as well, we've seen the small caps also underperform the large caps, and that is also a recession indicator as well. So it seems that is also on a lot of radars as well.
You look at gold prices spiking up, and there's
a lot of safe haven signals there. I mean, that's to be expected too, right? And when we look at recession indicators, a lot of these also do have false flags.
They do.
You get those every so often as well. So we should note that potentially also being a factor.
Absolutely. So I mentioned that since 1969 it's been effective, but actually I believe in 1954 it missed recession. It didn't call for one, even though there was. So not necessarily a false positive, just completely missed the ball. And actually people say that that's a really good reason why maybe the yield curve isn't a good indicator right now, because back in 1954, very similarly, treasuries were very low. They were around 2%. And also the federal funds rate was near the zero bound as well. It was also around 2%. So when you think about the picture being in a low yield, low interest rate environment, that's very similar to what we have today. But yet still, we are seeing the yield curve get really dangerously close to inversion. And if it does invert, I mean, you do wonder about what the impact of the market would be. But
because everyone always believes that's a recession indicator.